What if the method one major global power is using to finally exit a devastating war by, repurposing hundreds of billions of dollars in seized foreign assets is actually threatening the very foundation of its own global financial dominance?
That is the pivotal question, really. It's the core insight driving our sources this week. We've been drilling into this comprehensive 28-point peace plan for the Russia-Ukraine conflict, but we're looking past the ceasefire language. We're focused on the dramatic financial mechanism that underpins the whole deal.
And the ripple effect it's already having.
Exactly, the immediate consequential ripple effect across major economies like China and India.
So our mission today is to unpack the specifics, the very transactional details of how these frozen Russian reserves are planned to be used. And here's the twist, right? This act of short-term financial engineering.
Right, an attempt to solve a geopolitical problem.
It's inadvertently opened what analysts are calling Pandora's box. It's escalating what they call counterparty risk and really speeding up this global push away from the dollar.
Well, the essential question for central banks everywhere has become, if they can just seize and repurpose the reserves of one nation, how secure are our reserves? And, that question is forcing a complete overhaul of global financial strategy overnight. The consequences are already measurable.
Before we go further, make sure to hit subscribe and support Geo9. Okay, so let's start right at the source. This 28-point peace proposal, it feels very much like an endgame document. It outlines these huge geopolitical shifts like banning NATO membership for Ukraine, inviting Moscow back into the G8. But the U.S. financial guarantee component,
Yeah.
that's where the rubber really meets the road.
It is the ultimate transactional resolution, yes. I mean, under this proposed deal, the U.S. provides a critical guarantee. So if Russia invades Ukraine again, all global sanctions snap right back into place.
Okay.
And any recognition of new territory would be instantly revoked. But for providing this security, the U.S. receives a massive compensation. The sources suggest it's a fee that could run into the tens, maybe even hundreds of billions of dollars.
So the conflict ends, most Western sanctions get lifted, and the U.S. effectively guarantees future peace, but gets paid handsomely to do it. It seems like a pretty elegant way for Washington to end its liability, but our sources are very clear that Europe pays a much, much higher price for this.
That's the real irony here. The U.S. has already spent over $100 billion in aid and weapons, but it's direct liability.
Yeah.
It's wrapped up. It's compensated. Meanwhile, Europe's economies are described as being in smoldering ruin. They're facing mass deindustrialization, energy insecurity, and they have almost nothing to show for the sacrifices they've made. Their economic damage is long-term.
And that distress, that leads directly to the core financial issue here, the hundreds of billions in frozen Russian assets. The plan's core assumption is that Moscow will get none of this back. Not in cash, not in bonds.
No, they're being carved up for very specific purposes.
So what does that really mean? How are they being carved up?
The funds are channeled into three specific buckets, basically. The first is a $100 billion tranche for U.S.-led reconstruction in Ukraine. So that means American companies, American manpower, are primarily used for the rebuild.
And they get a cut?
A big one. Those U.S. companies receive 50% of the profits from this massive venture.
Wait, hold on. If the U.S.-led effort takes half the profits, who gets the other 50%? That sounds like that sketchy part our sources pointed out?
It is. The source notes that the allocation of the rest is highly ambiguous. It's not clear if it goes to Ukraine, to the EU as some kind of compensation, or maybe even to Russia in some weird offset mechanism.
Yeah.
What is crystal clear, though, is the immediate benefit to U.S. corporations in construction and engineering.
And at the same time, Europe is being told to match the effort even when they're in this strained economic state.
Precisely. Europe is expected to contribute another $100 billion to this fund. The sources really emphasize that, given Europe's current condition. The high energy costs, the deindustrialization. Finding this money will be, and I'm quoting here, extremely painful, maybe even impossible.
So they're underwriting a reconstruction effort where the U.S. profits using cash they desperately need at home.
That's the long and short of it.
Okay, here's where the motive seems to shift from reconstruction to something else. Future resource security. The rest of the frozen funds are slated to go into a new, separate U.S.-Russian investment vehicle for joint projects.
That sounds completely counterintuitive if this is supposed to be a punishment for Russia.
It does. But it reveals the deeper geopolitical agenda, which is all about the U.S. trade conflict with China. That joint investment vehicle is intended to develop resource mines, secure critical rare earth supply chains.
Specifically in the territories captured during the conflict. Yes. Yeah. Now, Ukraine at one point claimed there were, what, $15 trillion in minerals in these areas? But our sources rightly call that figure wildly optimistic and a vast overestimate.
So the true motive isn't really humanitarian reconstruction. It's about securing access to vital supply chains that the U.S. desperately needs to counter China.
That's the conclusion the analysts draw. By setting up this joint structure, the U.S. locks in a long-term economic interest in the region. It's securing the raw material extraction, the mining side of the supply chain. That's a critical weakness in the U.S. strategy against China, even if China still dominates the refining part. It gives the U.S. huge long-term resource leverage.
If this perspective feels useful, take a second to subscribe to Geo9. It genuinely pushes me to keep bringing more research stories.
Yeah.
Okay, let's pivot now. Let's talk about the fallout from all this. The moment any nation seizes sovereign assets, they're trading a short-term geopolitical win for a profound long-term financial risk. This action it's the moment Pandora's box opens. It raises a huge question. If the US and EU can just reach into sovereign reserves, who on earth still trusts holding US debt?
And this is where we have to talk about counterparty risk. Think of it this way. Your country's sovereign wealth fund holds its reserves, usually U.S. Treasuries or euros in U.S. or European banks. You're treating them like the world's safest safety deposit box.
Right.
The moment those assets are seized or used without your consent, the bank, the U.S. or EU system, has shown that it can use your security deposit for its own purposes. Trust evaporates.
And trust is replaced by the need for immediate physical control, which is why we see this quantifiable shift away from financial assets and toward things like gold.
Precisely. The flight to gold is dramatic because gold can't be frozen or weaponized through SWIFT. Before the conflict, central banks were reporting about 15 tons of unreported gold buying a year. In the year since the asset confiscation, that number surged 14 times. It's over 200 tons annually now.
Wow.
This is not casual buying. This is a systematic, urgent replacement of dollar reserves with physical bullion.
And you can see this same movement away from the dollar in the hard numbers of Treasury bond dumping, too.
Absolutely. The BRICS nations, many others in the global south, they're systematically cutting their exposure. I mean, look at the numbers for 2025 alone. India dropped its holdings by $23 billion. China, if you combine the mainland and Hong Kong, reduced its holdings by nearly $80 billion. Even Brazil is aggressively shedding U.S. bonds.
So for these countries, it's not just about trade anymore. It's a strategic decision based on the instability that U.S. policy created.
It's a simple risk calculation.
Now, this part is easy to miss, but it fundamentally changes everything. China's strategy is moving beyond just dumping bonds or doing bilateral trade in yuan. Our sources say they are now targeting the final boss, the Eurodollar market.
Yes. And to understand why this is such a critical target, we should probably define it quickly. The Eurodollar is this massive established system where companies and countries borrow and lend money in U.S. dollars, but they do it all outside of U.S. jurisdiction.
So it's dollars circulating globally, fueling international trade.
Exactly. And the size. How big are we talking?
How big is it?
It's monstrous. If you just look at loans and bonds, it's about $13 trillion. But when you factor in all the related paper swaps, forwards, derivatives, the size explodes to an estimated $76 trillion. And crucially, the liquidity of the Eurodollar system drives global demand for the dollar even more than the old petrodollar system does today.
So if you want to decouple the world from the dollar, you have to break that Eurodollar credit cycle.
You have to. So if China wants financial deleveraging, attacking that global credit market is the ultimate way to do it.
And how is Beijing actually doing this? How are they telling their own banks to execute this attack?
It's a top-down mandate. Beijing is pushing its big commercial banks to actively reduce their outstanding dollar loans. And at the same time, they're being told to aggressively increase their external assets denominated in RMB, in yuan. This is not accidental. It's a concerted effort.
And are we seeing results yet? Is it working?
This shift is already tangible. Since 2020, Chinese external RMB assets, so that's loans, deposits, bond investments held by foreign entities, they've quadrupled. They've hit nearly $500 billion. And in that same period, their dollar asset holdings have systematically dropped. The transition is happening fast.
That seems like a really difficult shift to enforce, though. Why are global borrowers actually accepting this move from the dollar to the yuan?
Because the incentives are lining up perfectly for them. The source calls it a perfect storm. First, there's a huge financial advantage. Current U.S. interest rates are sitting above 4%. Chinese loan rates are way lower, sometimes below 1.5%.
So swapping your loans saves you a ton of money.
Massive cost savings for any major corporation. But there's a second incentive, too. Supply chain logic. The vast majority of global borrowers China is targeting. They're sourcing their inputs, their machinery, their components directly from China. So it's just practical to borrow in yuan if you're going to be spending that yuan on Chinese goods anyway.
And underneath all of this, the primary motivation for China is sovereign protection, shielding themselves from the exact counterparty risk we were just talking about.
Exactly. This is financial deleveraging designed to protect China from future Western sanctions. If their banks and their trade partners are less exposed to the dollar, they're less vulnerable to being cut off from SWIFT.
The financial nuclear option.
Right. And China is building insulation against it.
Okay, let's talk about the final piece of this puzzle. The huge gap in China's reported financial activity, the opacity of their economy. What does that imply about the actual scope of this de-dollarization effort?
The opacity is intentional. Reports suggest the People's Bank of China has been severely underreporting its gold purchases for decades. Historically, we might see them report, say, 1.5 tons of buying, when the real number was closer to 15 tons, a factor of 10.
Wow.
So if that ratio holds true today, when official buying is already high, then China's real gold acquisition for 2025 could be well over 240 tons, all behind the scenes. They are systematically replacing their vulnerable dollar holdings with physical bullion, while at the same time launching this attack on the Eurodollar system.
So we have a clear trade-off here. Utilizing these frozen assets solves a huge short-term geopolitical problem ending the war, securing rare earth supply chains for the U.S. But the long-term price is speeding up this economic divorce from the dollar, and the source is clear this divorce is going to be nasty and long drawn out.
What's truly fascinating, and maybe deeply concerning, is the prioritization. The U.S. objective really appears to be simply to be done with Russia and Ukraine. Even if the path to getting that done means sacrificing stability in the global financial system that Europe and the global South rely on so heavily, they are externalizing the cost of that stability to the rest of the world. And that is the essential, critical takeaway of this deep dive.
So how do you see it? Drop your thoughts in the comments. And if you haven't subscribed yet, join Geo9 so you don't miss the next insight.